the authority of being his dad when I say you're going to trade the morning session, knowing full well that this will at least give him a baseline. And then if he wants to change up and go to trade in the London session or trading the afternoon session in the US, he can make that decision because he'll have the same protocols that he uses here, just at a different time of day. And I'm not willing to make changes. I don't want to sit up in London. I don't want to do that all over again. I don't want to do that. So since this is, second time for him to go through this, it's dad saying, okay, I'm not willing to make changes to my schedule. I'll do it once to show you the logic. And for all of you that are here wanting to learn, and you have an interest in that time of day, but you'll see that nothing's really changing. It's just you're applying the same concepts of measuring time, determining where the liquidity is, and then waiting for this disruption. And the waters are made jagged or rough. Wherever it's smooth, okay, you're waiting for that jaggedness to come in. And if you look at what has been shown here, what I traded off of is these relative equal highs, this up close candle. I'm anticipating that as a bearish order block. Why? Because it's going above the relative equal highs. We had the market trade lower. It went beyond the opening price. Listen, folks, this is for order block fans, okay? My order block does not require to trade below the wick. If I understand the narrative, and let's talk a little bit about narrative. This morning, my interest was being short. I wanted to be short because we had a nice run all last week, and we really didn't see TGIF on Friday. I talked about it with Caleb. I said, I believe it could do it. It could potentially have a retracement as much as 20 to 30% of the weekly range. It didn't do that. They kept pressing it into Friday's close. Okay, wonderful. So how do I trade with that information knowing that TGIF did not form on a Friday? If the market didn't retrace 20 to 30% of previous week's range, and if it's an up close week, if I see that that's likely to happen, but it doesn't deliver, let's say I took a trade on Friday and I was trying to get short and it just didn't it didn't pan out and it petered out and maybe it caused a losing trade, or maybe it didn't give me a fill, or it just didn't give me what I thought was going to happen. The end result is what was lacking. TGIF did not materialize and manifest itself on a Friday. Wonderful. So fast forward to Monday. If you're going to trade on Monday, and this is true even if there is CPI and PPI on Tuesday and Wednesday or later in the week, you can use this information. Anticipate the likelihood of 20 to 30% of the previous week's range occurring on Monday's trading. So it's TGIF, but the actual retracement of it is deferred to the following week. In this case, it's Monday. Do you need 20% of the previous week's range to be profitable? No. But it's one more little box to check that probabilities are better in the short than going long. So then when you start mapping out your day, 7 o'clock in the morning, as I outlined last week, determine what your initial high for buy side is and what your initial low is for your sell side. Wait for them to be taken. And if you have the weekly gap, the new week opening gap and the new day opening gaps are below price, and you have that function of determining, okay, well, it could retrace into some of previous week's range. You have a lot of things going in your favor that point to what? The initial run will offer you a range, so that way you can determine some kind of directional bias. That bias doesn't have to be the daily range bias where you're predicting the close is above or below the opening price. Remember, it's session bias too. And you need to be able to determine that first, Caleb. You need to be focusing on, in the morning session, I want to know where a run could form that is measurable. It's something that I'm able to participate in, and it's one-sided. Okay, wonderful. If you can see that we're above the new week opening gap and we have new day opening gaps below the market at 7 o'clock or 8 o'clock or 9 o'clock at the opening bell, then you know the weight of the market is going to be pressed to the downside. So the market's going to discover, probe into, discount a raise. That's something that's below the market price, and or seek inefficiencies that are deep retracements into previous week's range, or just taking out short-term lows that can be determined from a 15-minute time frame.